What moved the needle today wasn't just the red on the tape, it was a complete fracture in the market narrative. For weeks, we've debated whether the economy was cooling or heating up. But today, investors were forced to confront the arrival of a stagflation shock. Today was a watershed session. We saw a rare and uncomfortable alignment. An economy losing steam at the exact moment an energy shock is accelerating. The S&P 500 fell more than 1.25%, erasing the relief rally we saw earlier in the week. The Nasdaq led the downside, dropping 1.5% as high growth names were squeezed between recession fears and rising inflation. The real alarm, however, was in the fear gauges. Volatility, as measured by the VIX, exploded nearly 25% to reach its highest level in months. This wasn't just typical profit-taking. It was an aggressive move by institutions to hedge against a systemic tail risk. Meanwhile, crude oil went parabolic, surging nearly 13% as the physical reality of a closed Strait of Hormuz finally hit home. What changed the psychology today was the collapse of the safe passage narrative. Emergency talks in Doha, intended to secure a corridor for energy tankers, ended without an agreement. The market has now shifted from viewing this as a temporary disruption to a permanent blockade. Qatar's energy minister even warned that Gulf exporters could halt production entirely, which has investors eyeing a potential move toward $150 a barrel. At the same time, we saw a jarring shift in domestic data. The jobs report showed we are actually losing private sector positions, yet wage growth remains stubbornly high. This creates a stagflation trap for the Federal Reserve. They are now facing a slowing labor market that screams for rate cuts, but an energy and wage spike that makes cutting rates almost impossible. Today's capital flow was a story of degrossing investors simply shrinking their footprint. Money moved into consumer staples and energy as the only viable bunkers. We also saw gold finally behave like a true safe haven, rallying nearly 2% as investors lost confidence in the US dollar. The most telling sign of distress was in Bitcoin. It fell nearly 5%, proving that in a moment of true systemic fear, it is still being traded as a high-risk asset rather than digital gold. Institutions are effectively selling whatever is liquid to cover losses elsewhere, beneath the surface. A more technical risk is emerging in the private credit markets. We've seen the first major write-downs in private funds as high interest rates and falling software valuations begin to bite. This is a silent credit crunch. Because these funds don't trade on public exchanges, the pain is often hidden until a redemption halt occurs. If these liquidity pressures spread, it could force a second wave of selling in public equities as funds raise cash to meet redemptions. The market's current stability is far more dependent on these private credit dams holding than many realize. Today signals a medium-term regime shift. The Goldilocks era where data was just right for the Fed to support the market is over. We are moving into a period where bad news is actually bad news. In the past, a weak jobs report would have been cheered because it meant rate cuts were coming. Today, it was feared because it signaled a recession that the Fed may be too inflation locked to prevent. The next test of this new reality comes next week with the February CPI report. If that data shows that the oil spike is already leaking into the broader cost of goods, the stagflation trap will tighten even further. We are also watching the earnings of major software firms like Oracle and Adobe. These will be the ultimate tests for the software Magellan thesis whether AI disruption is truly eroding the moat of legacy tech. Strategic takeaway for investors. The market has entered a confirmed stagflationary regime. What this suggests for investors is a pivot towards simplicity and quality. In an environment of economic weakness and persistent inflation, the market is no longer rewarding broad exposure. It is rewarding those who can hide in cash flow, avoid leverage, and maintain maximum liquidity.